Stock market crashes don't scare anymore. There is an unfair trick that the smartest investors use to protect their money, even during crashes. And no, it is not panic selling. It is not running to fixed deposit or blindly buying gold. It's a mix of four proven strategies that will hedge the risk. It will reduce the volatility and it will ensure steady returns. Stay till the end because I've got some real data and charts prove that even during the worst market crashes, smart investors don't just survive, they've made money. And if you like creative videos such as these, which are investing lessons that are actionable, please consider liking this video. It helps me stay motivated. The first technique is the put option strategy, an insurance to your portfolio. Let us understand hedging with a simple illustration. Most people panic after market crashes, but the pros hedge even before it happens. A simple put option costing say just 2% of your portfolio can give you peace of mind. I will show you when to buy it, not during panic, but when the valuations are stretched. To grasp this concept of hedging, we will have to examine historical data of premiums versus market condition and assess their effectiveness. However, here I am simply going to explain the concept with a sample chart. Let us use the recent option chain only as an example. Real data may vary as the price is very dynamic. I am not discussing futures and options trading. This is purely for long-term investors who want to protect their portfolio against market crashes. Let us assume Nifty is at 23,000 and you want to insure your portfolio against a potential market drop. You want to protect yourself at the level of 22,000, meaning you don't want to risk the markets falling below this level by a certain date. Here, let's say December 25. Now looking at the option chain, that is the insurance, technically called buying a put option, 22,000 is called the strike price, 486 rupees is the premium that you need to pay for it. This means if the market falls below 22,000 by December 25, your losses will be compensated. Now let's break this down. 486 rupees is roughly 2.2% of 22,000. This represents the cost of insuring your portfolio. Again, let me reiterate. This is just an example. The actual premiums may vary. It's very dynamic and it keeps changing every second. Now, if the market crashes below 22,000, you are protected. If the market stays above 22,000, until that expiry date, you don't get anything back. 486 rupees is gone. It is like life term insurance cover. The premium is gone, but you have the gift of life. One key insight, the right time to buy this protection is not after the correction, because after a fall, the risk usually decreases. The damage is already done. Instead, the best time to hedge your portfolio is when you can see huge gains in it and the valuations, price to earnings, etc. are stretched way beyond the historical average. And also the premium depends on how long you need this insurance. That is the expiry date of the put option. Let me also tell you that investors don't need to hedge their portfolio at all times because it is both costly and also unnecessary. However, a major market crash or a downturn, there are usually warning signs to this, such as increasing volatility, extreme valuation, negative economic indicators. Investors can use these signals to hedge only when needed, rather than constantly pay for protection. There are also some caveats. For example, you can buy puts for large cap indices like Nifty with ease, but your portfolio may be small cap oriented. So the protection may not be perfect due to difference in volatility and correlation. This is called mismatch risk. Then there is a cost for this hedging and premium decay. Buying a put option incurs a cost like the insurance premium, and if the market does not decline significantly, the premium paid is a sunk cost. And if you do this frequently, this can lead to long-term returns dilution. Additionally, you can only buy puts for a certain fixed amount or multiples called lot size limitation. If your portfolio falls between these two lot sizes, you may either have to overhedge or underhedge, making risk management less precise. This is a very detailed topic. I'm just offering you a very broad roadmap. You have to learn about risks such as, say, expiry risk, how implied volatility affects the price of the put option, and risk related to liquidity. This can make it hard for you to exit the position. And then, due to false sense of security, investors might take excessive risk, assuming that an option hedge will fully protect the portfolio. However, hedges only provide for partial protection and should be used as a part of a broader risk management strategy. This is an interesting field of study, an exciting area for investors who are committed to long-term growth and who are eager to deepen their knowledge. So the second technique is using the SIP to reduce the risk. A simple SIP can be a powerful hedging tool. SIP works because it forces you to buy low when others are panicking. Data proves that over every major crash, SIP investors have outperformed lump sum investors. Let's see this with data. This is the chart returns plotted from 2008 to 2014 of a sample small cap fund. So if you did lump sum at the peak valuation in 2008, you made zero returns for the next 6 years. Same here, an investment in 2018, a lump sum, in a sample small cap fund made zero returns for the next 3 years, that is till 21. However, in the same period, 2008 to 2014, if you had invested in SIP, you made 13% in this period versus zero in lump sum. Jan 2018 till 21, if you had invested through monthly SIP, you would have made 19% return versus zero returns if you had invested lump sum at the beginning of 18. Long-term time orientation is also a hedge in itself. As you can see in this chart, the probability of earning high returns increase over long holding period. The percentage of time a fund has given negative return is 28% in 1 year, but virtually becomes zero when it is held for a 7-year period. The probability of earning negative return decreases while the likelihood of earning high returns increases with longer holding periods. The third is multi-asset rebalancing. Call it the autocorrect hedge. Most people stick to only stocks or sometimes fixed instruments, but protection comes from multi-asset rebalancing, shifting between equity, debt, and commodities such as gold based on market conditions. This chart here explains some magic that happens when you mix. A simple way to understand this concept is through an AMC presentation I saw. 1 atom of carbon and 2 oxygen creates carbon dioxide. This is used as a refrigerant or in fire extinguishers or inflating life jackets. But 1 atom of carbon and 1 atom of oxygen creates carbon monoxide, which is highly toxic and flammable. So the properties change completely when 2 or 3 different asset classes are mixed in different proportion. Look at this chart. We may go for a pure fixed instrument like FD or a debt fund with the idea of avoiding risk. If a 100% debt fund investment generates a 7% return, risk measured as volatility is 6.9. Now you add 25% equity to this portfolio, the risk remains at 6.9, but the return has gone up to 9.7%, almost 40% more with no additional risk added. This chart explains how you can reduce your risk in a 100% equity portfolio by introducing debt. By lowering the equity exposure and adding 30% debt to the portfolio, the risk drops significantly, yet it continues to deliver returns comparable to a long-term equity-only portfolio. In this chart, you will see how adding gold has reduced the risk even more. A portfolio comprising 25% equity, 55 debt and 20 gold has delivered the same low risk as a debt instrument has delivered, yet it has given higher returns. So by adding gold and debt in your portfolio, you can reduce the risk without commensurate reduction in return. The fourth is the patience hedge. Why markets always recover after every crash? But how long does it take? I will show you a chart of every correction, how deep it was, how long it lasted, and how fast it recovered. This isn't just data, this is a mental hedge, knowing when to hold, when to add more. This represents Nifty 50 correction. In the last 34 years, there have been approximately 48 corrections exceeding 5%. 9 of them were significant, greater than 20%. Each of these corrections eventually recovered and market continued to rise, driven by improving earnings of the underlying companies. During such corrections, we focus on the risk, but after recovery, we often see them as missed opportunities. This chart shows in each of those corrections how much did the market crash, how long it took for those corrections to happen, how long it took for it to recover. 2020 it took only 2 months for the market to crash 38%, 8 months to recover back. And Nifty delivered 62% return on recovery. In 2000, it took 20 months to crash 51% and to recover, delivering 106% recovery. Market crashes are inevitable, but they don't have to be devastating if you know about hedging and the risk management strategies. We explored 4 powerful techniques: put options, SIP investing, multi-asset rebalancing, patience hedge. Please let me know if you have ever hedged your portfolio, what strategies you choose during market chaos. Please consider liking this video, sharing it with your friends, and subscribing to this channel.